Imagine holding $1,000 in your hand and knowing exactly how to make it grow. Not just a little, but significantly. In 2025, the financial landscape is more democratic and accessible than ever before. You don't need to be a Wall Street titan or have a huge inheritance to start building real wealth. The tools are right here, at your fingertips. Whether you're aiming for slow, steady growth or are ready to take a bold, calculated step toward financial independence, this video is your blueprint. We're going to break down the absolute best strategies to invest that initial $1,000 and turn it into something truly impactful for your future. Quick disclaimer. This video is for educational and entertainment purposes only. I'm not a financial advisor, and this is not financial advice. Always do your own research or speak with a licensed professional before making investment decisions. Section 1. Build a financial foundation. Before you even think about putting that $1,000 into the market, we need to ensure your financial house is in order. Skipping these fundamental steps is like building a skyscraper on quicksand. It just won't last. Tackle high-interest debt first. Do you have credit card balances with 18%, 20%, or even higher interest rates? Or maybe a payday loan with astronomical fees? Prioritize paying these off aggressively. Think of it this way. No investment out there can consistently beat the guaranteed return you get by eliminating debt that's costing you 20% or more annually. It's a risk-free, high-yield move that protects your future earnings from being eaten away by interest. An emergency fund. Life is unpredictable. Cars break down, unexpected medical bills pop up, or job situations change. Having an emergency fund, ideally 3 to 6 months worth of essential living expenses saved in an easily accessible, liquid account like a high-yield savings account, provides a crucial safety net. It prevents you from having to sell investments at a loss or go back into debt when unforeseen circumstances arise. This fund gives you peace of mind and keeps your long-term investment plan on track. If you're debt-free or have a solid plan to be soon, and have that emergency cushion in place, congratulations. You've set yourself up for success, and your $1,000 is ready to be a powerful tool for growth. Section 2. Choose your investment path. Now for the exciting part. Where can that $1,000 make the biggest impact in 2025? Here are your top options, catering to different goals and risk tolerances. In 2025, many high-yield savings accounts are still offering competitive rates. This is fantastic for short-term goals because your money is FDIC insured up to $250,000, meaning it's incredibly safe. Crucially, these rates often beat inflation, ensuring your purchasing power isn't eroded by rising prices. Treasury bills, T-bills, these are short-term debt instruments issued by the U.S. government, making them one of the safest investments available. They are backed by the full faith and credit of the U.S. government. You can purchase them directly via Treasury Direct or through accessible exchange-traded funds, ETFs, like BB Hitch, invest in short-term T-bills. They offer excellent liquidity and competitive yields for your cash. 2. Index funds or ETFs. For most people, especially those just starting with long-term wealth building, index funds and ETFs are the champions of diversification and simplicity. The power of trying to pick individual winning stocks, which is incredibly hard even for pros. An index fund or ETF allows you to own tiny pieces of hundreds or even thousands of companies. This drastically reduces your risk. If one company struggles, it's a small blip in your overall portfolio. Long-term growth. History shows that diversified market investments tend to grow significantly over the long haul. The power of compounding, where your earnings start earning their own returns, really takes hold over years and decades. Your initial $1,000 could be worth many multiples of that in the future. Easy access and popular choices. Platforms like Fidelity, Vanguard, and M1 Finance make it incredibly easy to invest in these funds with minimal fees. Consider diversified funds like VOO, Vanguard S&P 500 ETF. Tracks the performance of the 500 largest U.S. companies, a cornerstone of many portfolios, offering broad exposure to the American economy. VTI, Vanguard Total Stock Market ETF, gives you exposure to virtually the entire U.S. stock market, including large, mid, and small cap companies. This is considered one of the most comprehensive single fund investments. QQQ focuses on the NASDAQ 100, which is heavily weighted towards technology and growth companies. While more concentrated than VOO or VTI, it offers exposure to innovation leaders. Dollar cost averaging. With only $1,000 to start, you might put it all in at once. But as you add more money over time, remember the strategy of dollar cost averaging, investing a fixed amount regularly, regardless of market highs or lows. This smooths out your purchase price over time and reduces the risk of trying to time the market. Invest in yourself, education, skills. This is arguably the highest return on investment, ROI, you can make, often far surpassing any market returns. Skill acquisition. Use that $1,000 to take a specialized online course or workshop in a high-demand field. Think AI prompt engineering, advanced coding, data analytics, graphic design, digital marketing, or e-commerce strategies. Platforms like Coursera, Udemy, and various boot camps offer a wealth of high-quality, targeted training that can directly translate to a bigger paycheck. New income streams. This investment isn't just about learning, it's about transforming your earning potential. That $1,000 could lead to a brand new freelance gig, a significant pay raise at your current job, or even the launch of your own profitable side business. Imagine turning that initial investment into an extra $500 to $1,000 per month in incentive. That's a return you won't see anywhere else. 4. Buy fractional shares of top stocks. The advent of fractional share investing has been revolutionary for those with smaller capital, democratizing access. Apps like Robinhood, Public, or SoFi have made it incredibly easy. You no longer need to spend hundreds or even thousands of dollars to buy a single share of a company like Apple or Nvidia. You can simply say, I want to invest $50 in Apple, and you'll own a fraction of a share. Targeted growth. This allows you to specifically invest in companies you believe in, even with limited funds. Focus on established, solid performers with strong financials like Apple, Microsoft, or Nvidia, or explore promising sectors like cutting-edge AI or renewable green energy companies. It gives you direct exposure to individual company growth without the high entry barrier. 5. Small allocation to crypto, optional and high risk. For those with a higher risk tolerance and an understanding of the extreme volatility involved, a very small, speculative allocation to established cryptocurrencies might be considered. High risk, potentially high reward. The crypto market is known for its dramatic price swings. While it offers the potential for significant returns, it also carries an equally significant risk of substantial losses. It's a highly speculative and unregulated market. Limit your exposure. We're talking about a very small percentage of your total investment. Perhaps 5 to 10% of your $1,000, so $50 to $100. Never invest more than you are truly, genuinely willing to lose entirely. Establish platforms. If you choose this path, use secure and reputable platforms like Coinbase, Kraken, or Gemini. Focus on major cryptocurrencies like Bitcoin or Ethereum, which have greater liquidity and a longer track record compared to thousands of newer, unproven tokens. Section 3. Example portfolios. To help you visualize how to actually allocate that $1,000, here are 2 sample ways to break it down, catering to different comfort levels with risk. Conservative starter portfolio. This portfolio prioritizes broad market exposure, stability, and diversification, offering a balanced approach with lower risk. It's a great starting point for those who want steady, long-term growth with less volatility. $600. S&P 500 ETF, VOO. This forms the core, giving you exposure to the largest U.S. companies and benefiting from the overall growth of the American economy. $200. High-yield savings or Treasury bills. Provides a solid, safe foundation for liquidity or short-term goals, earning competitive interest on your cash. $200. International ETF, VXUS. Diversifies your portfolio beyond U.S. borders, allowing you to participate in growth from economies worldwide and reduce reliance on a single market. Growth-oriented portfolio. This portfolio leans more heavily into higher growth sectors and individual assets. While it carries more risk and potential volatility, it also offers the potential for greater returns over time. $400. NASDAQ ETF, QQQ. Invests in the top 100 non-financial companies listed on the NASDAQ, heavily weighted towards tech and innovation leaders. $200. Fractional growth stocks, e.g., Nvidia, Tesla. Allows you to pick specific companies you believe have high growth potential, even with a smaller budget. $200. Online course or skill building, a direct investment in your human capital designed to boost your income potential. $200. Small crypto allocation, a speculative, high-risk, high-reward component for diversification into a new asset class. Section 4. What not to do. Just as important as knowing where to invest is knowing what to avoid, especially with your first $1,000. Steer clear of these common pitfalls: meme stocks and viral TikTok investment tips. These are often based on hype, not fundamentals. They can pump up quickly and then crash, leaving many investors with significant losses. Real investing is about strategy, not social media trends. Get rich quick crypto tokens. Beyond Bitcoin and Ethereum, there are thousands of new cryptocurrencies, many of which are highly speculative, lack real-world utility, and are prone to pump and dump schemes. Research thoroughly before even considering these. High-fee apps or trading platforms. Excessive fees can eat away at your returns over time. Stick to reputable brokers with low or no trading commissions and reasonable expense ratios for ETFs and index funds. Every dollar saved on fees is a dollar that stays in your pocket and can grow. Putting everything into one risky asset. Never put all your eggs in one basket, especially with a new or volatile asset. Diversification is your best friend when managing risk. Remember, the primary goal with your initial investment is to grow your money responsibly, not to gamble it away on short-term fads. Final thoughts. That initial $1,000 may not feel like a fortune, but it is far more than enough to start building serious financial momentum. It's a statement, a tangible step toward a more secure and prosperous future. Whether you choose to invest it in the broad market, in yourself and your skills, or even a strategic blend of both, the single most important move you can make is starting today. Time, consistency, and intelligent decisions are your greatest allies in wealth building. Future you will undeniably thank you for taking this crucial first step. Now I want to hear from you. If you had an extra $1,000 today, how would you choose to invest it in 2025? Drop your investment strategy or any questions you have in the comments below. And if you found this video helpful, don't forget to like, subscribe, and hit that notification bell so you don't miss out on more smart money content. Right here on NextGen Digital Finance.